Energy Markets live video podcast. Today is Friday, March 3rd, 2023. And we've got three experts with us here this morning from different parts of the world with a good geographic representation and spread. We have James McCallum, CEO and Chairman of Exergy Group and Professor of Energy at Strathclyde University. Rustin Edwards, Head of Fuel Oil Procurement at Euronav, and Jose Chalhoub, Political Risk and Oil Analyst at Venergy Global, joining us from Venezuela. Thank you all for joining us this morning.
Thank you.
Thank you.
Thank you. And sometimes it sounds like we're in a world of paradoxes right now, or at least a world of bifurcations. OPEC raises output while U.S. consumption of diesel and distillate fuels ends the year at the slowest rate for a decade. The U.S. is considering raising rates higher than their December projections, even though in many ways it's still grappling with historic inflation. And given this context, Rustin, I'd like to start off with you and by focusing a bit on the production side of things. OPEC raised its crude oil production in February by 120,000 barrels per day amid a rebound in Nigerian output, even though it continues to be well below the OPEC plus quota. But in January, we saw a decline compared to December when Saudi Arabia slashed output by over 150,000 barrels per day. And within this context of geopolitical events, we just passed the first anniversary of Russia's Ukraine invasion. We saw the price cap on Russian products kick in December, and we're seeing these ongoing changes in global energy flows. I wanted to start off by asking you, do you anticipate an additional increase coming out of OPEC Plus for the month of March?
Well, I mean, again, as you started off there, OPEC is underproducing by about 1.8 to 1.7 million barrels a day versus the quota. So there's plenty of upside potential in OPEC. It depends on what countries can get themselves back together. Nigeria has been a very good example. They've been able to increase security around the pipeline systems as well as the oil export platforms. So they've been able to stabilize their production and get their production back up. I mean, I think you have other areas such as Iraq that could also increase production a wee bit more. So you could see more and more upward bias moves on a lot of the, let's say, secondary OPEC members to produce higher. I mean, I think Kuwait, Saudi Arabia, and UAE are going to keep themselves kind of static where they're at until they can have a general, more larger consensus from the group around forward demand. But for nevertheless, I still think we're going to see creep probably more to the upside as countries get themselves more stable and get themselves back into a better position production-wise, and you don't have a lot of disruptions that have happened over the last couple of months when it comes to either weather delays or against the earthquake in Turkey and Syria, which that tragedy in itself impacted OPEC's exports to the world. So I think that's going to be some of the criteria we're going to see coming into March, that we'll just see more creep upward.
So we see this upward flexibility on the OPEC side. And James, shifting the focus a little bit to the US side of things, we've heard this week reports of what's considered hot data coming out of the US that may force US Federal Reserve to raise interest rates higher than the 5.1 to 5.4% range that the Feds had been targeting and projected as recently as December. And we've heard that that's due to an excessively strong labor market coupled with strong demand, as well as these price pressures that continue in the market. And this, of course, all of it is happening within the backdrop of the Feds having tightened monetary policy really aggressively in 2022 to fight historic inflation, but then having slowed the pace of the hikes starting in December. And at the time in December, it was described as disinflationary by Fed Chair Jerome Powell. And given this backdrop and this context, what is your take on these pressures? Do you think the Feds will have to give in to these pressures and raise interest rates beyond the projections that they had as recently as 2 months ago?
Clearly, there are contrarian views at play in the market right now, and that's what you've just articulated. I think the answer is, for me, is if the blip information or the blip data to which you refer proves to be correct, then I think yes. I think the answer is that the Fed will continue on its pathway to do what it needs to do to drive that inflationary pressure down. The United States economy is proving remarkably strong in the face of all of this, and that's the contrarian part of the whole story. If the blip data is correct, inflation rate rises from the Fed, I think, will continue. If we find ourselves with that job data softening or whatever, and the Fed getting the impression that that they are controlling inflation, albeit in a disinflationary environment, but slowing down, then I think that drive to keep pushing, sort of 25 basis points up or whatever, will begin to ease. But for me just now, I think it kind of feels, there is an increasing uncertainty that inflation is entirely under control. And so if I had to flip one way or the other, I would say that that I think that the Fed will put back into the circuit another rise geared towards showing that they are in control of this thing and that they will do whatever it takes to drive down inflation.
Like you said, the US economy is proving to be surprisingly resilient and strong at this point in time. And shifting a little bit to the consumption side of things within that same US context, Jose, I'll throw this out to you. The US consumption of diesel and of distillate fuel oils ended last year at the slowest rate for a decade because of a slowdown in manufacturing and freight activity. The volume supplied to the market for distillate fuel oils is often used as a proxy for general consumption and averaged around 3.7 million barrels per day in the month of December, which was down from 4 million in the same month the previous year. And this was the slowest for that time of year for December since 2012, so a full decade before. And growth in the manufacturing activity peaked in mid-2021 as the economy rebounded from the first wave of the pandemic. So we've seen these swings and in some ways these markers that haven't happened since 2012. And since then, in the last few months, it's slowed and turned negative since the final months of 2022. Do you think that we'll continue to see a decline in the rate of consumption coming out of the US, or is there a potential for a reverse in that trend for the next couple of months?
Well, thank you, Tomas. That will depend much on first of all, on what will unfold with the decisions that the Fed will continue to make in terms of hiking interest rates. That's one key determinant. The other issue is how the economy in the United States will behave. And for that, I think the relationship that's been unfolded recently with Venezuela will be also important in terms of how Chevron, for example, is ramping up recently production. But the old existing production that in its joint ventures existing here in Venezuela. But for that, I think that it will much depend on the dynamic of the US economy.
And continuing, you mentioned Chevron and Chevron's reintroduction of Venezuela that involves, the U.S. government giving it permission to re-enter that market. It happened, maybe 2 months ago. A few days later, after Chevron got permission to re-enter that market, the company's top executive met with Venezuela's oil minister, who is a man that the U.S. has accused of drug smuggling. And given Chevron's reintroduction to that country, do you see any, or what are the geopolitical implications you see coming out of that decision to let Chevron re-enter the country, and then days later meeting with arguably a main American adversary?
Yeah, well, it was pretty remarkable, the decision that coming from the US OFAC by giving this new license for Chevron that will last for 6 months. But this new production coming online is mostly related to payments of all debts that PDVSA had with Chevron. I think will be also crucial after this license expires, if this will lead to new investments by other U.S. oil companies, for example, by Exxon or ConocoPhillips. That will lead to a ramping up of the production here in Venezuela. Recently, the OPEC monthly report signaled a hike of Venezuelan production to 720,000 of barrels per day, mostly prompted by the restarting of the production by Chevron. So it'll be very important. Also, I think, and I've stated this many times, how recently news came out that Venezuela is receiving this distillates and condensates from the U.S., displacing a little bit the condensates that it was receiving from Iran. So that'll be crucial as well, how Caracas will, manage and play this equilibrium game between the U.S., Russia, and Iran.
And with not only just Chevron's reintroduction, but also potentially other American players and through joint ventures and other players and re-entering or entering for the first time the Venezuelan market, from the geopolitical perspective, again, how serious would you say that the U.S. is at this point in getting Venezuela back to global oil markets?
Well, I mean, we're close. I mean, traditionally, Venezuela and the U.S. have been close partners, traditional partners, because of the geographical proximity. We used to export to the United States more than 1 million barrels per day before all this crisis came in, and the wave of expropriations came in during the Bolivarian Revolution under the former President Chavez. But I think, I mean, it'll be important for the U.S. to try to bring more Venezuelan oil to the market, considering all these geopolitical context, specifically now that Russia, for example, is applying a cut of its oil production of 500,000 barrels per day.
And moving a little bit back to the OPEC and OPEC plus side of things, considering the dynamic between the US and Europe as an increasingly big market for the US, the OPEC plus meeting in February showed that the group is determined to maintain its strategy and to avoid sudden and drastic moves in either direction. And it was expected that after the December Russian price cap kicked in, that Saudi oil would increase to Europe, but that hasn't happened. And instead, Saudi export to Europe have sloped downwards. And Rustin, I'm curious to ask you, with the US providing now an ever-increasing share of Europe's energy needs, do you think that this trend will continue and that Saudi will continue to potentially get pushed out of that market?
Well, I mean, it all just comes down to the economics of the arbitrage flow and the next available market for the oil. So, US oil, WTI, shifting now, it's going to become part of the Brent assessment, I believe by the middle of the year. So that means that it's going to continue probably flowing from US Gulf Coast into Europe. It's a light sweet crude, which a lot of the European refineries like to have. It has a very good yield point for gasoline and distillates, which helps the market there. So it is a case on what the refinery wants to buy, the ultimate price of the fuel coming in, and what the needs are of the market. Relatively heavy sour crudes are not something that the market needs in Europe, because if you look at the gas oil cracks, they've been averaging around $24, $25 a barrel, which means that the incentive is to bring in more medium distillation crudes. So that makes your West African grades and your US grades far more desirable than a Saudi grade, which will have a higher fuel yield. So there is that piece of economics that come into quality of the crude versus what the needs are from the local refining system. So I think China will continue to still support and bring in Middle Eastern grades, because they need to use that to basically dilute themselves from the amount of heavy sours they're buying from Russia via Urals, as will India. So you'll see that flow continue, probably remain in the east, but that then pulls demand from North Sea crude that was transiting all the way to China, as well as West African crudes that were flowing to China. So you almost get this bifurcated crude market where the east of Suez stays east of Suez, and all your Atlantic Basin crude stay in the Atlantic Basin and service that local refining basin.
And with the east of Suez, bringing in a little bit more Russia into the conversation, Russian crude is becoming strong competition for Iraqi crude in the Indian market. So again, this Asian focus, and Russia has fleets of tankers sailing into India and pushing Iraq's exports out of that market, probably giving a lot of sleepless nights to a lot of Iraqi policymakers at this point. And James, I'm curious your take how Iraq can react to something that emerged so suddenly, and at the same time, something that's probably going to remain in place for months, if not years.
Yeah, it's going to be difficult. I mean, picking up on Rustin's point and the point that was made earlier, the markets are clearly working right now. If you look at the price of oil, it's remained relatively stable. If you look at, if you listen to OPEC's position, that stability dimension is something which is driving their policy right now. They don't feel the need to make any major moves. They feel in control. The incremental ability to increase production if it was absolutely needed is there. So I think we have a market that is functioning right now, even as we come out of IEE week in London, where the rhetoric was, towards a very strong second half of the year. You're beginning to hear the stories of the major IOCs who have remained relatively quiet in the space of investment, beginning to come forward. Their share prices have bounced back, particularly the European IOCs, off the back of announcements that they're going to retract a bit back towards conventional hydrocarbon production rather than embracing the energy transition story. We can talk a lot about that. But the reality is that the IOCs are now looking for, where will I make that investment? Clearly that they're not investing in new activity in the shale plays. That's all around recompletions. It continues to be about that, maintaining production from existing wells, not adding new stock. And when you were talking with Jose about Venezuela, and he was reflecting upon Chevron's activity there, that is going to be what we will see, Thomas, is that the major IOCs are looking, where can I invest my petrodollar and get the best return from it and the best production from it? And not surprisingly, off the back of US potential policy moves, the major IOCs are looking south into South America, Venezuela, returning into that market. Can we make that market work? And I think that answers your point around Iraq. I mean, the reality is they have to look at where they can make their market work in this new dynamic, which, as Rustin said, is east of Suez, west of Suez. There are shifts in terms of where production is actually going, but the market is working.
So the market is working. India, or Iraq rather, is probably, like you said, on the hunt for where can it get the biggest bang for its buck. What are the markets to probably target with a more of a scope now that it's having this competition from Russian crude into the Indian markets, but maintaining its focus on east of Suez. Are there any opportunities for Iraq to find new buyers in Asia, or maybe potentially in China with China's reopening? And would that kind of would that shift in markets come at a substantial cost to Iraq if it wants to hone in on east of Suez and on Asia?
Yeah, look, the conversation into Asia, I think, is a very dynamic one. If you take a look at, clearly there was a bandwidth of projections at IEE week as regards where demand will go in the second half of the year, where production will go. But broad consensus seemed to kind of put demand growth somewhere, around 2.2 to 2.5 million barrels of oil a day in the second half of the year, and supply at 2.1. So supply underneath demand. So the reality is that there is going to be tension in the market out there, and Iraq just needs to identify where the potential buyer for their crude is. I think the Saudi has, and the United Arab Emirates for that matter, has over the course of the last 5 years increasingly looked to the east, both in terms of production and supply, but also in terms of investment back into the Middle East. And that market was shifting over the course of the last 5 years. What we're beginning to see now, I think, is a relatively clear picture around who is beginning to go with who for the longer term. The India component, which you mentioned, is a very, very different play. The India component around Russian oil is all around a price point. India has been very clear that they need a lower kind of price point to the sort of 80, 85 to make their economy work. And they have been very successful at making the Indian economy work by using increased production from Russia into that marketplace. And clearly the world is acknowledging that production into India and accepting it as a part of the whole dynamic of the Russian-Ukraine conflict, because it is keeping that stability in the oil markets. And if the oil markets like anything, more than it's stability rather than volatility.
And I wanted to bring in today's survey question, and Jose, I wanted to get your take on it first on this theme of Russia, on this theme of potential alliances or market flows that are going to continue. They're starting only now to form and will continue for the foreseeable future. We've spoken about Russian crude movements around the world that in some ways keep advancing and finding markets in spite of price caps and restrictions coming from the West, as well as Russia itself sometimes indicating that it's going to cut output again in the future. And the survey question for today is, can global oil and gas resources meet demand in the second half of 2023 if Russian cuts start to bite the market? And Jose, I'd like to get your take on that, please.
Well, I think in terms of the potential changes in the oil flows and all this, I think South America could play a very important role, especially considering the cases of Venezuela. This year, it will be very important to watch if things continue regarding the dynamic of its oil production. Also, the case of Guyana, we've talked this before, Guyana is projected to continue to ramp up its oil production up to 500,000 barrels per day. It's been already exporting oil to Europe, first cargoes to Europe. The case of Brazil, it's also very important, despite all the fuss about the arrival of Lula again as president in the country. Petrobras is a very strong company, very heavy company, and is still producing over 2 million barrels per day. The quality of most of Latin American crude oil is it's very attractive for the oil market. So in general, I think that Latin America as a hub could play a very key role in considering the impact of these Russian oil cut.
You mentioned Guyana, which I think is a very interesting case study right now. The projections for Guyana are quite impressive, and maybe not necessarily when compared to existing top oil producers, but the fact that Guyana is essentially starting from zero, coupled with the fact that it was potentially the economy that grew the most in the entire world for 2022. Kind of looking at this Guyana trajectory, do you think that Guyana has the potential to become a top-tier oil producer?
It'll depend, because there's two things. It has the lowest break-even costs per barrel in the whole South America, and so across South America in terms of production, it goes around $25-30 per barrel of production of costs, and the quality of its crude oil, it's very attractive as well. It's light oil. So, but I think that it'll much depend on how the Guyanese government will handle all this riches, because it will be inevitable the emergence of corruption cases surrounding all this riches for a country that it hardly reaches 1 million inhabitants. So it'll much depend on how the political landscape, the social landscape, and the macroeconomic landscape in the country will handle all this. But definitely, I mean, for me personally, in the last 2 years, Guyana has been one of the most interesting cases to study, because also it represents a competition to Venezuela.
Right, exactly. And within the Latin American context, we've mentioned Venezuela and Guyana so far, but of course there are other heavyweights in the region. There's Mexico with Pemex, there's Brazil with Petrobras, and of course Brazil just switched presidents, and Lula is back in power again after his first run at the presidency a decade ago. And especially in the region in the past year, there were a ton of presidential elections throughout the region, and we saw this swing of the pendulum from the right back to the left. And given that context for the Latin American region as a whole, kind of giving a bird's eye view perspective, do you think that current geopolitics and these trends, these political trends that we're seeing in the region, will impact the supply coming out of Latin America, or in what ways would geopolitical events impact the supply from the continent?
Yeah, generally speaking, I think that or the oil industry in South America, it is a meaning of politics interfering with all the oil companies in terms of corruption, in terms of the state handling or putting in charge people of trust in the different state oil companies. I think that this year will be crucial in terms of the of how the price of oil behaves and the rest of the critical commodities, as Latin America is a key commodities exporter. So if we see a like a low price environment all this year, it'll be very much difficult for Latin America and for the wave of leftist government to try to behave like the past wave of leftist government, which turned to be more radical than the ones that are in power today.
And as we near the end of our time together, we mentioned Guyana as an interesting case study, and another developing interesting case study that comes to mind out of the US is these talks that are happening now on whether or not to get rid of changing the clocks twice a year. So on the American side and on the legislative side, US Senator Marco Rubio has reintroduced legislation to make daylight savings time permanent across the country. And it's called the Sunshine Protection Act, which passed the Senate last year, but then stalled in the House. And then changing the clocks twice a year, of course, was first introduced at the beginning of the 20th century with the purpose to save oil and electricity during World War I. And I remember growing up in Pittsburgh as a kid, my family was always late to everything twice a year or early, depending on the time of year, because we never knew that the clocks were changing. And back then it wasn't like having a phone right now that just changes automatically. And it was pretty disruptive for that one day. But now in the 21st century, daylight savings time is not as closely associated with energy savings anymore, even though studies have been done that estimate that millions per year per state could be saved in electricity bills if these changing of the clocks was a thing of the past. So James, I'm curious your perspective on that. If the US were to proceed with a permanent daylight savings time and no longer changing the clocks back and forth twice a year, do you think that there might be a non-negligible impact on energy consumption in the American market?
Yeah, so Rustin and I were having this conversation just before we started. I think both of us concluded that if this change was made, it might make a humorous point on the evening news broadcasts, but little more than that. I think like yourself, it's an issue that confuses more than it explains around the world, whether it's the United States or indeed it's Europe, much the same thing. In all honesty, I think it would be a fun story for a day, and it would be yesterday's news. I don't know what Rustin thinks.
Yeah, I think it's more of a nothing burger. It's like, and okay. Because inevitably, just because you shift the time zone, you're still going to have shorter days in winter, longer days in summer.
Yeah, there you go. And Thomas, just one particular point. I was talking with Sean in London around giving increased acknowledgement to the chat room. There's a comment in the chat room which clearly is responding to something which I said, which was around the role that India has played in the oil markets around oil price. And one of the listeners is asking for an acknowledgement that the position that India has in the world markets has played a role in terms of stability. I think that's an interesting spin to whoever wrote that. I think clearly the price of oil going into India has had a stabilizing effect in terms of global oil price, but it's more around the retention of production in Russia finding a market and the global markets acknowledging that as a part of the supply equation. So whilst India has benefited from that in terms of price and maintained its economy, would I have the view that India has taken a leading role by accepting cheap oil in terms of maintaining stability in global oil prices? Not sure I would go that far.
Well, as we run up on time here, the survey question is back on the screen. Can global oil and gas resources meet demand in the second half of 2023 if Russian cuts start to bite? Overwhelmingly, yes. So definitely something to keep an eye on. But with that, we've run out of time, but I'd like to thank the three of you for joining us today, James McCallum, Rustin Edwards, and Jose Chalhoub. Thanks for taking the time to speak with us, and have a great rest of the day.
Thank you very much, Thomas. Jose, Rustin, bye-bye for now.
Bye-bye.